Welcome to the CoreLogic overview of Australian housing market conditions for June 2016. Following the 1.7% rise in capital city dwelling values in April, the May numbers were almost as strong, with our Hedonic Home Value Index rising a further 1.6% over the month. The latest results take the combined capitals index 5% higher over the first 5 months of the year, which is in stark contrast to the final 5 months of 2015, where capital city home values actually fell by 0.2%. The annual rate of capital gains is once again accelerating on the back of these recently stronger housing market conditions. Capital city dwelling values are now 10% higher over the past 12 months. Sydney and Melbourne have continued to see the strongest annual increases in home values, up 13.1% and 13.9% respectively. There's also some evidence that value growth is starting to spread towards other capital cities, with home values 7.1% higher over the past year in Brisbane, 6.1% higher in Hobart and 5.7% higher in Canberra. Values have continued to rise in Adelaide, although the rate of growth has been fairly moderate at just 3.9% over the past year. Home values have continued to fall in Perth and Darwin on an annual basis. They're down 4.2% and 3.5% respectively. The strength in the CoreLogic indices is backed up by several other indicators. Auction clearance rates in Sydney have held in the mid-70% range since the last week of April, and weekly clearance rates in Melbourne have been higher than 70% almost every week during 2016. Additionally, the number of events across CoreLogic's valuation platforms, which account for more than 95% of all bank valuation instructions, are up almost 7% over May, which is the highest level of activity since March last year. Housing finance data for March shows that investors, as a proportion of all new mortgage commitments, have been trending higher since reaching a recent trough in November last year at 42.9%. The March data shows investors now comprise 47.6% of all new mortgage commitments, the highest proportional reading since August of last year. Anecdotal evidence suggests that investor numbers may have increased further from this time, with some lenders starting to loosen their lending policies for investment purposes as growth in investor-related credit tracks well under the APRA speed limit of 10% per annum. Lower mortgage rates are also likely having a positive effect on consumer confidence and on housing market conditions, with the standard variable mortgage rate now at its lowest level since 1968. Although home values are continuing to rise, it's a different story across the capital city rental markets. Across the combined capital cities, rental rates have fallen by 0.3% over the past year, setting a new benchmark for the weakest annual rental change on record. While rental rates are falling, home values are continuing to rise, and subsequently, gross rental yields are continuing to trend lower. Gross rental yields across the combined capitals dwelling index are currently recorded at 3.4%, having fallen from 3.7% 12 months ago. Although housing market conditions appear to have picked up over recent months, I'd be surprised if such a strong pace can be sustained. Affordability constraints in the largest cities are likely to be one of the factors standing in the way of further gains. Sydney dwelling values have increased by 58% over the past 4 years, and they're 86% higher since the beginning of 2009. Although affordability factors aren't as pressing in Melbourne as they are in Sydney, dwelling values have increased by 71% since January 2009, and they're 39% higher over the current growth cycle to date. Additionally, lending policies are now tighter than they were a year ago, with most banks now requiring higher deposits and becoming more risk-averse, particularly within new apartment markets and in areas that have seen rapid appreciation of values. The low rental yield profile may add further disincentive to investors who remain a substantial component of housing market demand. Yields have compressed across most of the capital cities. However, gross rental yields in Melbourne and Sydney have fallen to new record lows over recent months as capital gains have substantially outweighed rental gains. In saying that, investment in housing is likely to remain a popular investment option despite the low yield profile, as long as capital gains remain strong. Relatively safe asset classes like cash and bonds continue to offer up little in the way of returns, and the volatility in equities has likely shaken the confidence of some investors. Some lenders have recently relaxed their previous restrictions on loans for investment purposes, which could result in a rebound in demand from this segment over the coming months. Thanks again for tuning into our monthly housing market update. Remember, you can find more detailed analysis and commentary at our website www.corelogic.com.au.